So central banks and supervisors have a very long tradition or habit to cooperate and to work together. It's been a long experience starting in the 1920s with central banks from the five largest financial countries at the time working together and trying to exchange views on how to regulate the foreign exchange market, the gold market, etc., and turning to financial supervision gradually, meaning that they wanted to be more involved in the supervision of financial intermediaries. So finance by nature is global. Banks have a global network of activities, so naturally supervisors and central banks wanted to make sure that there was a level playing field for them. And they also wanted to better understand what was going on, meaning that financial activities are complex in nature. It's difficult for supervisors to, by their own means, understand what's going on if they don't have a global view. So which is why they need to exchange views, share their understanding, share their experience, etc. And thirdly, they also needed to join forces in order to adequately supervise those financial players. It goes always through the same pattern, meaning that you start working on standards, developing standards across regulators. You go as far as you can go, meaning that you also need to transpose that in your national or regional legislation at some point. So you cannot agree on something when you do standards. You cannot agree on something that you know you won't be able to transpose in your positive legislation afterwards. Secondly, you enforce that with your institutions, and thirdly, you also check on implementation. So there are peer reviews, cross reviews, making sure across jurisdictions that those standards have been implemented properly across the board. It's very important also to understand that there are challenges associated to that. Supervisors, regulators need to be accountable. Of course, one key purpose is fostering financial stability. So we've seen that regional cooperation increased or improved after episodes of financial crisis. It was very clear when the Basel Committee was created, but also after the failure of BCCI in 1991, then when the Financial Stability Forum got created after the Asian crisis, but also after the mortgage and subprime crisis, the Financial Stability Board took the suite of the FSF. And in Europe, after the sovereign and Greek crisis, the banking union was created. So always, regional cooperation among financial regulators and supervisors was accelerated after episodes of financial turmoils or crises, and that was, in fact, a key driver in converging more and more to accommodate the developments of the global capital markets. The challenges maybe also, I said it's accountability. So you need to demonstrate that you're accountable. You are operating within a very clear mandate, which is given by the governments, by the treaties, by all sorts of arrangements which empower regulators to work together. And afterwards, you are also controlled, of course, by things like in Europe, the European Court of Auditors, checking on what banking union is doing when it comes to banking supervision. So there might be a lot of technical work on the ground, but it's under the auspices of a mandate and also checked afterwards by different sorts of stakeholders.